What's up, guys? It's Jake with Shoemaker Invest. As promised in my last video, this video is going to focus on the numbers and running numbers before you buy a property, and these are the numbers that I ran before I decided to purchase this. But this is good to do any general analysis before you either buy the property or look into a property further. And there's two different ways you can run the numbers for: a buy and flip, or a more of the buy and hold real estate, as in the BRRRR method, the buy, rehab, rent, refinance, and repeat. This video is going to focus on the buy, flip, and sell, and in my next video we'll focus on the BRRRR method. So a little background into this property. It is located in Schoharie County, New York. It's about 30 miles from where I live, and I went into it with my dad. This is kind of my learn property, to learn as much skills as I can. We already discussed that, not to focus on the numbers and the maximizing the return, but to learn so that you can, build your skills, work to learn, not to earn, and then go multiply this several times on different properties to make money. So it was listed for $25,000 on Realtor or Zillow, and we went in, took a look at it. It was pretty much gutted, so you could kind of get a real sense of how the bones of the property was, the framing, the foundation, and whatnot, which was helpful. Brand new roof, so that's nice. And we ended up offering about $21,000, and they accepted. And since the property is deemed unlivable, you can't get a mortgage for it. So a buyer would have to pay cash for it, which is what we did. And that is reflected in the purchase price. Typically, if you can't get a mortgage on it, a price for a property is going to be cheaper than if you can get a mortgage on it, because more people would be able to buy it because it's through a mortgage, and the demand would be higher. But this leads me into my money mindset number 2, and that is cash is king. And pretty much what that means is having a strong emphasis or importance on the cash flow or cash position of various businesses or even people. And I personally think having a very strong cash position on your balance sheet is very important. I always look at balance sheets before I buy stocks and companies, but more importantly in relation to you guys is I think having a lot of cash on your personal balance sheet is very important as well. And you don't see a whole lot of that today because everybody focuses on what they can buy and their spending as opposed to what they're bringing in and their cash reserves. Dave Ramsey always says have 6 months saved up in a safety fund or safety net for things that could happen, such as the coronavirus. But again, like I said, everybody seems to focus on as long as they can make a monthly payment, they think it's a good decision and they can buy it, when that's really not the case. Before I go off on a tangent, let's get back to this investment property. Like I said, we bought the property. They listed it for $25,000, and we ended up buying it for $21,000. And next we had to pay the closing costs. They were relatively cheap. They were $786. And the closing costs cover any cost associated with the transaction, real estate transaction. So such as the attorney fees, the realtor's commission, any filing fees or insurances or anything like that kind of gets roped into the general term closing costs. Now, I found this property on Zillow, so I didn't go through a realtor, and the seller also didn't go through a realtor either. We also ended up using the same attorney, so that made her job easier, which then she didn't need to charge us as much. And in New York State, you need an attorney to go through any real estate transaction. I'm not sure if it's the case in other states, but in New York, it definitely is. So this $786 made up about $250 for the attorney, another $150 for some filing maintenance fee or something like that, and then another $250 for title insurance. And that's always a good idea to have, and that just protects you as well as the lender. So if there's a mortgage, it would protect the mortgage company from any sort of issue with the title of the property. So if there were the seller had any back taxes on it or any liens against it or anything like that, it would protect you as well as the lender from having to deal with that. So the total cost of purchase was $21,786, and it was essentially ours. So next we needed to figure out what the renovation costs would be. And this is very difficult to kind of guesstimate and figure out, which I'll make a separate video on how we did that. But the number came to about $80,000 for an all-in cost of $101,000. Now, another thing you need to consider when you're flipping real estate are the carrying costs. So in column G, I listed out a couple examples of the carrying costs, and these are the monthly costs associated with owning a property. And these costs are on me to pay because the property's not making any money. So these just keep coming out of my pocket with no return. And they'll last the duration of the project until you either sell it in this case, or once it starts cash flowing due to a renter. Now, and they eat quickly into your profits. So it's good to get a property done as fast as you can. So the water and sewer, right now the property's not even hooked up to water, but the county charges kind of a flat rate of $135 a quarter. So that boils down to $45 a month. The taxes, again, the property's not assessed at really anything. I think it's assessed at like $15,000. So the taxes are pretty low on it. So right now I've been paying, I think, $120 a month. Electricity, it hasn't been hooked up to electricity except for until last month, and I just got the bill. That was $20, but we didn't use a whole lot of it. So my guess is it's going to be around $55 once we get going. The insurance, again, like I said, the property's not valued that high, so the insurance is pretty cheap on it. I don't have a big policy, but I will up that once it becomes worth something. And where the carrying costs really add up are in the mortgage, and or if you had interest on another loan, if you borrowed money from a hard money lender or something like that. Because the mortgage, you'd be paying a monthly mortgage on it, which obviously is expensive, and then or interest on a loan. So if I borrowed $100,000 at 12% a year, that's just $1,000 in interest that I owe each month just for holding on to the property. So those two kind of really add into it, but luckily for here we don't have that. So it's about $240 a month to carry the property, to have it during this renovation. And I've had it for 6 months, so far I paid about $1,400 just to have the property. Now I'm going to guess another 4 months the property is going to be done, so it's going to cost about $2,400 to hold the property, which brings our total cost of the investment up to $104,000. The next thing you need to figure out or estimate is the after repair value, or the ARV. And the best way to do this is to look in the area that the house is in for other comps and for very similar properties. This was very hard to do. Schoharie County is pretty small, and there's not a whole lot of duplexes set up like this, so it's very hard to figure out comps. So I kind of have a broad range of what I think it's going to be worth. I think it's going to be anywhere from $150,000 to $170,000. So to be conservative, let's say it's going to be $155,000 after it's done. So right now we're looking at $50,000 in equity, which is the difference between what it's worth and the cost of the investment. So in this scenario, we're going to be doing a flip and sell. So I'm no longer going to have the property, and if I were to sell, the closing cost would probably be about $5,000. So having a total return of $45,000. So we have this $45,000 figure. Now, is this good? Is this bad? It all depends. Now, most flippers really aren't self-performing the work. They are going to probably sub it out, and their only part of this would probably be to cough up the money, and well as to kind of do some high-level project management type work. Whereas in this property, this is all self-performed work, so that doesn't go calculate into the renovation cost like most other flippers would have it. Labor is essentially free because it's me, my brother, and my dad doing it. So to get a real good sense of how you did on this investment, you need to kind of break it out over the amount of man hours that went into it. So for instance, if this total project took 1,000 hours, you'd be getting paid at essentially a rate of $45 an hour. If it took 3,000 hours, that would be divided by 3, and you'd be looking at $15 an hour, which isn't too good. So there's a whole lot going in and a whole lot of perspective that you need to look at a property like this before you make your decision. Realistically, it's not going to take 3,000 hours. It probably won't even take 1,000 hours. So it's going to be a pretty good hourly rate. Another way to look at it, which is the more traditional way, would be the return on investment. And that would be, essentially right around 45%. You would take the 45, divide it by what it cost you. So, just under 45%. All right, guys, thanks for watching this video. In my next video, like I said, we'll take a look at the cash flow side of it and the BRRRR method if we were to do that. And then ultimately at the end of the project, I'm going to need to make a decision on which one is more favorable for me.